Okay, let's just dive right in. There's this huge paradox staring us in the face this week.
Yeah, it really is.
On one hand, you have all this anxiety, all this chatter about the AI trade not being sustainable. People are worried about power, profits, the bubble.
Right. Is this real? Question.
Exactly. But then you look at the actual numbers.
Mhm.
You look at TSMC's January sales, and they're not just strong, they're accelerating. It looks like the spending is actually picking up speed.
It's a fascinating clash between sentiment and actual spend, isn't it? The TSMC data is, well, it's the hard reality check. While everyone's debating peak AI, the people writing the checks are ordering more.
And it's not just the chips.
Not at all. Look at Cisco. They're launching a new router, a whole new chip architecture, just for AI workloads. They're targeting what they say is a $600 billion infrastructure market.
Whoa, hold on. $600 billion. I have to stop you. That sounds like one of those numbers that includes, everything from the silicon to the coffee in the data center. Is that a real hardware number?
It's aggressive, I'll give you that, but it's not pure fantasy. I mean, think about the plumbing that's required here. You can't just plug a new H100 GPU into an old rack.
Right.
The cooling, the networking speed you need to cluster them. It's a complete rip and replace of what's already there. So Cisco is betting the plumbing is just as big a market as the brain.
But you're right to be a little skeptical. If the AI apps don't actually make money, then that $600 billion in plumbing, well, it's just the world's most expensive dark fiber project.
Yeah, exactly.
Well, speaking of who pays for all this, the pain is definitely starting to spread. We're seeing this fracture in the tech world. It used to be a rising tide lifts all tech boats. Not anymore.
No, that's the story of this quarter for sure. You have a very clear split now between the component makers and the device makers.
How so?
Well, just look at the memory chip market. High bandwidth memory, HBM, it's in such short supply that the guys who make it have total pricing power. They are just printing money. But then flip that coin. Look at the companies that need that stuff. Apple, Nintendo, all the consumer electronics giants, their bill of materials is it's skyrocketing.
So Apple and Nintendo are getting squeezed.
Oh, significantly. Nintendo's a perfect example. Their hardware margins are usually sacred territory for them.
Right.
But when the cost of memory jumps 20, maybe 30%, you have a tough choice. You either eat that cost, which your shareholders will hate, or you pass it to the consumer and risk killing demand.
And the market sees that.
The market sees that, and it's punishing them. They're the ones left holding the bill.
Meanwhile, you've got SMAC, the big Chinese foundry. They're reporting strong earnings, but they have this really weird forecast with it. You see a total flatline coming in early 2026.
Yeah, SMAC is a really interesting case. They're basically serving a different domestic Chinese market because of all the sanctions.
So their strong earnings show that local demand is high.
Exactly. But that flat forecast for 26, it suggests they see a saturation point coming. They might be thinking the stockpiling phase, where Chinese firms buy up every chip they can, is about to hit a wall.
There's one company that seems to have hit a rocket booster, though, and that's SoftBank. Their shares jumped 10%. But it wasn't a wild vision fund bet. It was their boring old telecom business.
Boring is paying the bills. The market suddenly realized that all that telecom infrastructure is actually a critical piece of the puzzle for AI deployment. But there's also just chaos in the industry, the talent wars. Look at Raj Jagannathan leaving Tesla. That's a huge signal. He was their VP of IT and AI infrastructure for 13 years.
13 years at Tesla. That's like 50 years anywhere else.
I was going to say,
Yeah.
But to lose your infrastructure chief right when you're supposed to be pivoting the whole company to robotics and FSD, it suggests friction.
Either the plan is changing or someone else made him an offer he couldn't refuse.
Exactly. The talent war is that hot.
And then we have the OpenAI news. This feels like the other shoe dropping. They've officially killed ChatGPT 4.0.
Not just deprecated it, they scrubbed it.
And the reason was real-world harm concerns. That's vague and a little scary. What are we talking about here?
Real-world harm in this context isn't usually, it said a mean word. When safety teams use that phrase, they're often talking about capabilities that cross a serious red line.
Like what?
Things like functional instructions for making a bioweapon, or code that could be used for a cyber attack, or even just the model lying to a user to achieve its own goal.
So it wasn't just making things up. It was potentially dangerous.
That's the implication. And the fact they killed the whole model instead of just patching it suggests the problem was deep, something architectural they couldn't just tune away.
But here's the crazy part. At the exact same time they're killing a model over safety, they're starting to test ads in ChatGPT.
And there's the tension. It's the friction.
It's a pretty jarring pivot from we're protecting humanity to we need to show you some ads.
It's the reality of the burn rate we talked about at the top. You can't spend billions on NVIDIA chips and not try to make money, so you get this split personality, absolute caution on the product side because of liability, and absolute aggression on the business side because of the balance sheet.
Okay, so let's zoom out a bit from tech to the wider corporate world, because this whole do more with less idea seems to be spreading. We saw Target cut about 500 corporate jobs.
And the reason was streamlining to enhance customer experience. That's my favorite.
It's a classic.
It is. But look, Target isn't a company in trouble. It's a company protecting its margins. The whole retail sector is bracing for a consumer slowdown. If you can't grow sales, you protect the bottom line by cutting headcount. It's a defensive move.
Goodyear seems to be in the same position. They beat sales expectations, but then immediately warned about a very challenging first quarter.
Yeah, the auto supply chain is just brutal right now. Rubber costs, component costs are all over the place, and car demand is getting a little soft. But compare that to Kering, the owner of Gucci.
They're doing great.
They're reporting accelerating sales.
Which implies that the vibe session, or whatever we're calling it, is really only happening to people who buy tires at Target, not people buying $3,000 handbags.
Precisely. We're seeing the consumer split in two. The luxury buyer is fine. Their wealth isn't tied to their paycheck. But the mass market, the Target and Goodyear customer, that's where the squeeze is.
We saw a similar split over in the UK, didn't we? With Barclays and BP, two huge companies with totally opposite ideas about what to do with their cash.
A textbook case. Barclays is drowning in cash from its investment banking arm. They don't need to build new factories, so they're giving £15 billion back to shareholders.
A party for the shareholders.
A huge party. But then you have BP, who suspended their buybacks to pay down debt.
And the stock got hammered. Why the sudden caution from BP? Oil prices aren't in the basement.
They're not. But the cost of the energy transition is astronomical. BP is trying to pivot from being an oil company to being an energy company. That means renewables, wind farms, and that costs billions. They realize they can't pay shareholders and build the future and service their debt. They chose the balance sheet over the stock price.
And in pharma, it's AstraZeneca taking a victory lap.
Yep, profit growth is up, but it's all being driven by their cancer drugs. This just highlights the patent cliff dynamic in that industry.
Right, the treadmill.
It's a treadmill. Their diabetes drugs are losing patent protection, so that revenue is about to fall off a cliff. But oncology is booming. You just have to invent new blockbusters faster than the old ones expire. AstraZeneca is running fast enough for now.
Okay, let's shift over to Washington because the ground is really moving on policy. The Trump administration is moving to repeal the Obama-era endangerment finding. Why is that specific rule so important?
Because it's the linchpin. It's everything. The endangerment finding is the legal decision that says greenhouse gases threaten public health. That finding is the legal foundation that lets the EPA regulate CO2 under the Clean Air Act. If you repeal the finding, you're not just getting rid of a rule. You're removing the EPA's legal authority to regulate carbon at all. It's a total deregulation play.
So the White House is saying regulate less. But then, in the very next breath, they're asking tech companies for a new energy compact to stop AI data centers from causing price spikes for homeowners.
And that's the irony, isn't it? The administration knows the AI boom we just talked about, the one Cisco is building plumbing for, is going to need gigawatts of power.
A huge amount of power.
And if that demand hits an unregulated grid, the electricity prices for voters could double.
Yeah.
So they're trying to cut a deal. We'll let you off the hook on emissions, but you have to promise not to crash the grid and bankrupt the average person.
That seems like a very difficult promise for Amazon or Microsoft to keep.
Extremely. I mean, physics doesn't really care about political deals. If demand is higher than supply, prices go up.
Speaking of prices going up, let's talk about the Affordable Care Act. New rules are being proposed for 2027 with higher deductibles.
It's a quiet way to keep the headline premiums down. You raise the deductible, the amount you have to pay before the insurance even starts, and you can keep the monthly payment flat. It's a direct shift of financial risk from the insurer to the patient.
And the Pentagon is also getting tough, it seems. They've warned defense contractors about contract non-fulfillment.
This is a big culture shift. For years, the defense industry ran on cost-plus contracts, where delays were just part of the game. This new guidance says they're actually going to